bored have people become during the lockdown, and what's the latest quote-unquote sport that they've become involved in? Well, unfortunately, the sport has a little something to do with investing, and we've got some interesting numbers on that we'll share with you on this week's program. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on Sunday mornings on the News Radio WFLA Orlando network, along with 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with now over 11,000 downloads of our episodes. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So before we get to the latest sports and the latest news on the quote-unquote sports side of things, the big thing that people have been doing while they've been locked down in the various government lockdowns that have been happening during the course of this COVID pandemic, the reality is that one of the things that folks really need to be aware of, particularly now, is what exactly is going on with their credit score. You all know that having a good credit score is so essential, so crucial, a part of your financial life, that it affects so many different things, right? Whether you can buy a house, whether you can buy a car, it impacts all of that. And so the question is, do you really know what goes into your credit score and what's really on your credit report, and how, at the end of the day, you might be able to address some of the negative items that could potentially appear on your credit report? So this information actually all comes to us courtesy of an article entitled Knowing Your Credit Score, and more importantly, How to Clear the Negative Items from Your Credit Report. Comes to us courtesy of the folks at money.com, previously money.com. You may know of it better as Money Magazine, a publication that's been around since 1972. Pretty extensive article that we're certainly going to highlight in today's program, that we're going to put the full version of the article, of course, on our various social media networks, social channels. And so if you want to look at more of the information that we're going to talk about on the program today in much greater detail, we will have that article posted this coming week, so you can kind of dig into it a little bit more. And so the point of it, though, is to make sure that you are paying attention to your credit score and your credit report. But of course, first things first, right? Before you can understand the ins and outs, you need to know how to get a copy of your credit report. So one of the things that you can do is every year you are entitled to a free credit report from each of the credit bureaus. And there's 3 credit bureaus out there. It's Equifax, it's Experian, it's TransUnion. And you can either call the 800 number. That number is 877-322-8228. That's how you can request a copy of your free credit report. Or, as with anything, you can go to the website, and it's annualcreditreport.com. Now, make sure you go to the right one, because there's a lot of different credit score report websites out there that, at the end of the day, you've got to be very aware that you are going to the right one that is actually going to be the free one, if you will. So it's annualcreditreport.com. So one other item to be particularly aware of, particularly as part of the COVID response, that the folks at Experian, one of the credit bureaus, has announced that consumers are now able to request a free credit report from all 3 credit bureaus as often as once a week, with no negative effect on your credit score for the next year. And that's particularly important during COVID, because you may be one of those folks that's taking advantage of some of the forbearance provisions that was in the CARES Act, which gives you the ability to not have to make your mortgage payment or to not have to pay your student loan. All of those were provisions that were put forth in the CARES Act, which was the original or the biggest bill that was passed as the COVID response out of the folks in Congress. And the reality is that that legislation gave you the ability to not have to make those payments as a way to sort of get through this tough economic time. The reality is, of course, is that it's one thing to have the option to do that and have it not count towards your credit report. And then there's the whole other thing of making sure that your credit report doesn't reflect those negative items, even though you were told, hey, it's not going to affect your credit report. All it takes is somebody reporting that you didn't pay and to have an impact on your credit report. So I think now more than ever, it's so important to check your credit report to make sure that you have proper reporting of the items that are going on in your life. If you're taking advantage of some of these forbearance issues where you don't have to make these payments, you don't want your lender to then turn around unbeknownst to you and say, oh, well, he didn't pay. You've got to make sure that you are fighting for your right to be able to not have to make those payments these days. So it's certainly a good thing that some of the credit bureaus have now allowed greater access to your credit report. And certainly that's one of the things that you need to make sure that you are checking, particularly if you're trying to take advantage of some of the options available to you under CARES Act. The other part of the good news, if you will, is that the folks at Experian are also launching an error dispute program that's free of charge, that actually is a program where you can dispute the mistakes and receive resolution within 14 to 30 days. So that's a pretty good feature that is certainly a new provision in these COVID times that allows you to be able to ultimately take better control over your credit report. So number one, you got to, of course, get a copy of your credit report in order to understand what's going on in it. And then once you get the credit report, understand that there are 5 different distinct categories that make up your credit report and then ultimately determines your credit score. So here are those 5 categories. Number one, and the biggest category, is your payment history. That accounts for 35% of your credit score. Number 2, the amounts you owe. That accounts for another 30%. So right there, the first 2 categories, your payment history and the amounts you owe, account for almost 2/3 of your credit score. The last 3 categories make up the other third, and it's length of credit history, 15%, your credit mix, 10%, and then new credit of 10%. So payment history, I mean, that's pretty straightforward, right? Are you paying your bills and you're paying them on time? The amount you owe, if you owe a high amount versus a less amount, obviously a higher amount is going to affect your credit score more. The length of credit history, this is one where if you've got credit cards that you've had for a long time, you don't necessarily want to close them out, because the reality is that the length of your credit score or your credit history is a component to your overall credit score. And then, of course, looking at some of the other credit mixes and your ability to apply for new credit well. So all of that goes into the categories that are on your credit report. We're going to take a break. When we come back, we're going to talk about some of the negative impacts, some of the things that can negatively affect your credit score, along with what you can do to fix these. All that coming up next here on Dollars and Cents on News Radio WFLA Orlando. So we're talking about your credit score, your credit report. What goes into your credit report? And most importantly, in this segment, we're going to talk about some of the negative things that can impact your credit, and even more importantly, what you can do to improve those, or maybe even get them off of your credit report. It's so important now that folks really are checking out their credit score and their credit report, and the credit bureaus have sort of recognized this because they're letting you do it on a more frequent basis than ever before. But the biggest reason why you certainly want to check things out is if you're taking advantage of some of the options that are out there to enter into forbearance on student loans or a mortgage, you need to make sure that your lender isn't unbeknownst to you, reporting it back that, oh, they didn't make this payment. Because the reality is, under the CARES Act, you can certainly miss some payments on your mortgage or your student loan, particularly as a result of the governmental response to COVID. So that's one of the biggest reasons why you certainly want to be kind of in tune with your credit score and your credit report these days, along with perhaps the other big issue that's always out there is identity theft and just what the criminals do on a regular basis as a way to try and get access to your pocketbook. So one of the biggest things that you're doing when you review your credit score and credit report is not just looking at what you're doing and what's getting reported from your perspective, but what perhaps maybe others are doing that you weren't aware of. So certainly important to check it out now more than ever. We're going to talk about some of those things that can have a negative impact and what you can do to correct next here on the program. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where this very week our team of certified financial fiduciaries can help you change your life with a successful financial plan that provides you with peace of mind for the future. So what are those things that can negatively impact your credit? Well, a lot of them, I think we're all pretty much familiar with them. And the reality is that some of these can immediately drop your credit score by as much as 200 points, and they can be on your credit report for as long as 10 years. So whether it's a late payment or whether it's a simple non-payment, whether it's a charge-off whereby you just stopped paying and the lender just said, forget it, we're never going to collect this money. If it's a bankruptcy, obviously that's the one that can drop it by almost 200 points and be on there for as much as 10 years, depending upon the nature of the bankruptcy option that you chose. Foreclosures, another 100-point drop. If you're getting foreclosed on, repossession, same 100-point drop. If you've got a judgment against you or if someone's looking to collect money, those are the kinds of things that can certainly negatively impact your credit score. And then, of course, the other issue that we were talking about is the identity theft issue, and third parties actually wreaking havoc, if you will, on your credit. The longer that happens, let's say you're a victim of identity fraud and identity theft, the longer that happens and you don't realize it, the greater the difficulty is going to be to try and fix that. So again, one of the reasons why you want to kind of stay in tune with what's going on your credit score, your credit report. If you do run into that identity theft issue, and obviously we've talked about this in prior versions of the show, you've got the choice between a fraud alert or a credit freeze. The freeze, obviously, as you might well imagine, means that there's no new accounts that's going to be opened when you have a freeze on. That's a much more stringent reaction to the identity theft issue. Fraud alert means that you can still open new accounts, but there's some additional steps that need to be taken. So just be aware of those two options should anything like that happen to you on the identity theft side of things. So, okay, so maybe you've got some negative item on your credit report. You're looking to try and improve your credit score. How do you go about clearing those negative items? Well, first and foremost, if it is in fact something that is accurate, that is timely, that happened, it's going to stay on there. There's not really a whole lot more that you can do about that. But these are the ones that you're looking for, as perhaps there's a way to dispute what the information is that's on it. Maybe you paid the bill. Maybe there was an issue with the processing of the check. Maybe you never got told about the bill. All of those things can happen. And there are certainly things that you can do to try and clear those negative items. So the first thing you can do is dispute it with the credit bureau itself, have them do an investigation as to whether it's something that actually should be on your credit report. Another option is to dispute it with the person that is, or the entity that is reporting it, right? Going to the source, if you will, of that issue and discussing it with them. The professional repair services, obviously you're going to pay for that. Some are good, some are bad. It's sort of a mixed bag on that. There are some nonprofit consumer counseling services out there that might be helpful. I think those are probably more helpful if you're picture is really in distress and trying to figure out which ones to pay versus not, those kinds of things is really where the credit counseling comes into play. And then some other options that are generally out there, you could pay some amount for a deletion, meaning that if you pay the entity that you owe money to a certain amount of money, then you get them to pull that off of your credit report, and that's known as a pay for deletion. A goodwill letter, which is basically a ask for forgiveness letter. Those sometimes work, not very often, but if you're looking for things to do that could potentially help improve your credit score, certainly that is one of them. And I guess if all else fails, you just have to wait it out, because the reality is, and this is the part that most people miss, is that when you think about your credit score and your credit report, it's really meant to be a picture of your behavior over time. And I think this is one of the biggest misconceptions on credit scores and credit reports, is that somehow if you change your behavior for 6 months, that all of a sudden your credit score is going to jump dramatically. That's not really what's going to happen. Repairing your credit score is not some quick fix exercise, because the whole concept of a credit score and a credit report is to evaluate you as a borrower over a period of time. So there's this misconception out there that all of a sudden you wave your hands, you do this, that, and the other thing, you pay your bills on time for a few months, and your credit score is going to shoot up. That's not the case, because that's not, after all, what the credit report and credit score is all about. It's meant to really measure your behavior over time. So what doesn't work when it comes to trying to deal with negative items on your credit report? Well, ignoring it doesn't work very well at all. Going through bankruptcy is probably the worst thing that you can do, with a 200-point drop and the potential for that to stay on your credit report for up to 10 years. And then going and closing something that is already behind on payments. You're not going to magically get out from under that. That's going to be on your credit report. So just understand the things that make up your credit report and your credit score, and then also the things that negatively impact it, and at the end of the day, the things that you can do to try and fix it. And certainly there's a range of things that you can do. Most importantly, you want to certainly be checking it out to make sure that it presents an accurate picture of what you, the borrower, are all about. So thanks to the folks at money.com for forwarding us that article, and we're happy to talk about it on the program today because it's got some good information on it. And then we will also be posting that on our various social media networks, so you can kind of see the full extent of the article. It's a pretty full article that details a lot of the things that we've talked about in this past segment of the show in much greater detail. So we encourage you to check out our social media platforms and look for that article that we'll be posting this week, courtesy of the folks from money.com, and certainly has some good information in it. So we're going to slide to the break. When we get back from the break, we're going to shift some gears and talk about the latest sport that many people have decided to get involved in, right? During the course of the COVID pandemic, a lot of lockdowns, all the sports leagues got shut down. So what were people left to do? Well, we've got some numbers on it that may surprise you. Coming up next here on Dollars and Cents on News Radio WFLA Orlando. How bored has the average young adult been during the course of this COVID lockdown, and what entertainment options have they chosen? Well, we got some interesting numbers that we're going to share on this segment in the program, and it's going to come as a bit of a surprise to a lot of folks what we're going to share on this segment, but the numbers are pretty staggering. Welcome back to Dollars and Cents, where we help you make sense out of all of those different decisions that involve your dollars. Here on the program, we are Central Florida's longest running radio program, coming to you on Sunday mornings on the News Radio WFLA Orlando network, along with 96.9 The Game. Also, our program happens to be one of the top 25 financial planning podcasts on the World Wide Web, with over 11,000 downloads of our podcast. So be sure and check out our podcast channels on Google and iTunes and iHeartMedia as well, along with Spotify. So make sure you check us out there and subscribe to our channels. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides peace of mind for the future. So, what's the latest sport? Well, it's a redo of what we saw 20 odd years ago. There's no real competitive options out there. You can't watch ESPN, you can't watch football, basketball, baseball, whatever your sport of preference is. And you can't even go to the gym and play a pickup basketball game. So to cure that isolation, to cure that boredom, and to get those competitive juices flowing, apparently everybody's decided to become a day trader these days. Here are the numbers. E-Trade, which is one of the biggest online trading platforms, investors open over 260,000 retail accounts just in the month of May. That is more than any full year on record in terms of account openings. Not to be outdone, newer rival Robinhood, another trading platform that has a very popular app, had a record 3 million new accounts open in the first quarter of this year. Trades by individuals, investors, have more than doubled the usual retail activity, and individuals now account for, on some days, up to 25% of stock market activity on a given day. That is more than double the activity of prior years. The average age of those 3 million new accounts on the Robinhood app, 31. So let's talk about that. A lot of information, a lot of folks heading in that direction that are younger, that are perhaps maybe missing their sports, missing that competitive edge, and they've decided to trade stocks as their sport of choice. Good thing we're on 96.9 The Game, right? Because then that way we can kind of tie all this into sports, because there's not much sports going on. Pretty much the only NBA has kind of figured it out. Everybody else looks like they're falling apart. And so there's not many options. So you got a lot of people that are opening up trading accounts to get their competitive juices flowing. Well, before you go ahead and open up that account, let's talk about it and put that into some perspective based upon kind of what the risks are and what history. So average age 31 on those new accounts. If you're 31, you probably really don't know about Y2K and the dot-com bubble of the late 90s. Maybe you've heard of it, but you didn't see it, you didn't experience it. And so that history lesson is that during that time, there was a bunch of tech companies who weren't really making any money, saw prices surge dramatically, creating this day trading phenomenon. That's when it really kind of first started. And the view was it just couldn't go down. And what's interesting about that period of time is I actually had kind of a front row seat to that, because back in the mid to late 90s, I was actually an attorney, and was actually a securities law attorney, and my job was to write the prospectuses that you would give to investors to encourage them to invest in a particular company. And the reality is that back then you could do something known as pro forma financial statements. And basically pro forma should have been like another fancy word of saying, hey, what's the best case scenario? And if it is the best case scenario, here's how that's going to impact my financial statements. And the reality is everybody was doing it. And obviously there's been regulations that have passed that prevent that use of pro forma financial statements like they were being used back in the 90s. But it created the illusion that these companies were going to be someday highly profitable if events A, B, C, D, E, and F all happen simultaneously. The reality is, though, that because none of that happens simultaneously, then it creates a bubble, and it created the obsession of day trading. And of course, now we see that resurrecting itself. And this time, thanks to social media, we don't have to write massive prospectuses with pro forma financial statements. We can just hop into a chat room and chat up a particular stock. 20 years ago, they were known as boiler rooms, where you would actually pick up the phone and call people to try and entice them to buy a stock. Nowadays, you just log on to your computer, poof, you're in a chat room, and you can encourage purchasing of a particular company along the way. The reality is that in today's world with social media, that type of an approach has certainly been amplified by tenfold indeed. Number two, in terms of history, risk, and perspective, the access to highly sophisticated trading strategies is probably one of the most truly troubling developments of this. This is probably new since the last time we saw day trading amidst the dot-com bubble of the late 90s get really popular, is that this time around there's a lot more sophisticated high-risk trading strategies that are available that weren't available back then. And this is where you got to be really careful, because in the traditional setting, a brokerage firm is required to know their customer and approve strategies like options trading or margin trading or things like that, based upon the conversation with the customer in terms of determining their level of sophistication. Well, today with these online platforms, with these apps that are out there, nobody's really sort of having that conversation. It's really more, just kind of click through and sign on and enroll and, double check the answers. But for the most part, you can get access to some pretty sophisticated trading strategies, and it's really just a click away. The problem with those trading strategies is that options trading can do very bad things very, very quickly, particularly with some of the strategies that make it possible for you to lose more than what you put in, and still other strategies where there's no limit to how much you can lose. And there is a very tragic story out there involving an Alex Kearns, and this really is pretty tragic, who did one of these strategies where you can have unlimited losses, not really knowing what they were doing, didn't have any income. They got online, they were 20 years of age, they got into these unlimited downside, highly sophisticated trading strategies, and with no income, he proceeded to rack up a loss that was showing in his account of $750,000. The story is tragic because Alex committed suicide in reaction to that sizable loss in his account. Obviously, the SEC has gotten involved in this, and ultimately, you're going to see those options start to shrink. But folks, this is some serious stuff when you start talking about the easy access to highly, highly sophisticated options trading strategies that can create a massive loss without you realizing it. And that's the truly tragic part of it. And one of the biggest ways that what's going on today is different than what went on 20 years ago is the access is much easier for much more sophisticated strategies. We're going to take a break. When we get back, we're going to continue this conversation on the latest thing that's happening out there in terms of day trading and the sport that it has become when we return here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Talking about the startling rise in day trading and online trading that's happened, particularly during the course of this year as a result of the COVID pandemic, just locking everybody in and eliminating sports, and folks need an outlet. And so when you look at, for example, like the Robinhood app, average age of a person that is opening an account is age 31. In the first quarter alone, there were 3 million new accounts. So I wanted to spend some time on the program talking with you about some of the risks involved in that, give it some perspective and some history lesson on it. And what we're talking about before the break was obviously back in the late 90s, the dot-com bubble, Y2K, that created sort of the first run on the day trading phenomenon, and a lot of people got involved in that, and ultimately things certainly did not end well for a lot of those .com companies. And then the second thing that we shared is that there are a lot more highly sophisticated trading strategies that are available out there today that there was not. We shared with you the incredibly tragic story of a young man, Alex Kearns, who got involved in those sophisticated trading strategies, and all of a sudden his account is showing that he's lost $750,000. It's a tragic story in that Alex committed suicide as a result of that, and the SEC and FINRA has certainly gotten involved as a result of that. But just understand that the trading strategies are much more sophisticated that you can get access to with these online platforms these days. So be very aware of that. And then third, the reality is it's the old pump and dump. And that's the thing that you have to be careful about, is the notion of a pump and dump scheme has certainly been around. It's a very simple fraud whereby somebody starts pumping up somebody buys a particular stock of a particular company. They start then pumping it up and basically talking about it and creating stories and doing episodes on it. And ultimately, when that starts to generate interest, as you might well imagine, if you have more interest in a particular stock, more people buying it, well, guess what happens to the price, right? Fundamental supply and demand. If you got people demanding it, it's going to send the price up. And then when the price goes up, well, that is when you dump it. That's the notion of a pump and dump type of strategy. And today it's easier than ever to do that because of the power of social media platforms. So you've got a lot more of that kind of in the wings as well. So just be very careful of that, because what's happening in these chat rooms is sort of one of the oldest types of frauds out there, in the form of a kind of a bait and switch, pump and dump type of scenario. And then lastly, when it comes to these trading platforms and day trading, there's the reality. For every success story that you hear somebody talk about, there is a much greater degree of failures on it. And you only hear people really talk about how, the trade that they made money on, not necessarily all the different trades that they lost money on. And so it's kind of like how you think of sports, to relate it back to sports, right? Everybody remembers the notion of taking the winning shot and having it go in. They sort of forget along the way of all those other shots that they took that didn't go in. And so when it comes to investing and trading, I think oftentimes you kind of get that same mentality, that we as human beings remember the successes and the failures all sort of get muddled together. But you have to take the failures and the successes, and ultimately that drives your rate of return. And what's interesting about that, if you look at the actual trading data based upon Robinhood customers, and again, Robinhood, one of the more popular trading apps out there these days. If you look at the trading data between March and early June, the conclusion based upon the academic studies that's been done on it is that the more a specific stock was bought, the more popular it was, the worse, in fact, it performed. So folks, steer clear of this. If you're looking for something to be less bored or to do something more exciting, look elsewhere than simply playing with your money like this. Money is not a game. It's not a sport. It's supposed to be set aside so that you can have a better life later on. So be careful about this. Fortunately, sports is sort of coming back, so maybe that will slow down the amount of people that are looking to day trade as their sport of choice. Speaking of investing, it is certainly these days a tale of two cities out there, if you will, in the market. You have the tech stocks and those kinds of things doing really well. And we certainly talked about that on the program before, but then there's sort of the other side. And then when you look at the S&P 500, which is the 500 largest companies in America, 35% of those companies are down, still down about 20% since the beginning of the year through the end of July, even though the overall index is up about 2%. So the tech giants are certainly driving a lot of the performance of the index, but there's about a third that's still down, and down pretty dramatically. And so as an investor, that's why it's so important to really drill down into the actual details of what's in your investment portfolio. And we're going to give you 3 things as we conclude the program here in our last segment. We're going to give you 3 things that investors really should be looking at today to really get an insight into exactly what's going on inside their portfolio, because there really is a dichotomy, if you will, that exists out there in the market today based upon sectors that are doing well and sectors that are not. And I guess that gets us really to our first question, is that when you look at your investment portfolio, it's not enough to just kind of look at, okay, I own Fund A, Fund B, and Fund C, but you really want to drill down and look at what sectors do you truly own, right? I mean, there's a difference between how tech, healthcare, and communications services is doing these days versus, say, energy or real estate or travel and leisure. So it's important to have that information on your portfolio as a whole and be able to do that analysis of what the underlying sectors are in the investment mix that you have. Not enough to just look at the funds or the investments, but really take it a step further in terms of those details. And then along those same lines, you would want to look at what are your top holdings, because you want to be there looking at company concentration. You don't want your portfolio skewing to the point where you're owning 10% of a single company. That would certainly undermine the diversification that you're looking for in your portfolio. So it's important to kind of drill down past the sector allocation, but into, okay, what's the company concentration that I own sort of across the board? Because if you look at a company like, say, Microsoft or Amazon or Google, a lot of funds and investments will own those particular companies. And so you need to know, okay, fine, I might own the same company in Fund A or Fund B or Fund C, but at the end of the day, what's my total exposure across my portfolio look like? And so drilling down into it and kind of looking at your top individual corporate holdings is a great way to do that, because you certainly want to be careful that you don't have an over concentration in one particular company, particularly on those companies that happen to be the more popular holdings. And then number 3, really looking at how you are doing relative to the applicable benchmark, because after all, that's what it's all about. You really want to be able to have some basis of comparison. It's not enough to just look at performance, but make sure you're looking at that performance relative to what the overall benchmark, the overall markets have done. And that, after all, is sort of where the rubber hits the road, right? How you've done versus the benchmark is incredibly important. So as an investor, make sure you're doing that comparative analysis on how you're doing today. Look at sectors, look at individual companies, and then look at relative performance. So those are the 3 main categories that you want to be looking at today to really get a good insight into what's going on, particularly when we have this sort of tale of 2 cities that's happening in the markets today, where you've got big sectors that are down still a lot and others that aren't. We're going to wrap it on up and get on out of here. Thanks for listening to the program Dollars and Cents here on News Radio WFLA 96.9 The Game. If you're interested in catching the program again, be sure to check us out on our social media platforms at Nelson Financial Planning. Thanks for listening to the show.